In just the last 1 to 2 months, we have seen a number of small cap growth companies falling by 20, 30, and even 40% in some cases. And these companies released very solid earnings recently. So we're seeing this discrepancy between the stock price and what these companies are actually delivering in their fundamentals. So in this video, we're going to be taking a look at 5 different small cap growth companies. And of course, the first one up here is none other than HIMS and HERS. HIMS is down 44% from the highs that they hit back in October. The stock price is now trading at almost $35 per share, when back in October, the stock price was around $62 per share. And we have seen this over and over again from this company. Back in July, the stock was trading for almost $70 per share and proceeded to fall back to $42 per share in August, before again making that run up to around $62 per share and falling all the way back down to $35. And overall, across all of the companies that we are going to be talking about today, the fundamentals are remaining strong, but we're seeing a broader re-rating of these companies across the market. For HIMS, their revenue in their most recent quarter grew by 49% year over year to $600 million. We also saw their subscribers increase by 21% year over year. And overall, when you think about HIMS and the business model that they are playing in, they are really the #1 player in personalized health. And this is going to be a growing market in the years to come. Again, revenue increasing by 49% year over year. Gross margins came in at 74%, which is actually down slightly compared to a year ago when it was sitting at 79%. We also saw net income sit basically flat year over year. They brought in $15.8 million in the third quarter of 2025. In the third quarter of 2024, they brought in $75.6 million. However, they had a $60.8 million tax benefit that boosted that number. So again, basically flat year over year for net income. Free cash flow was also flat year over year, coming in at $79.4 million. One of the reasons I personally might not buy into HIMS is just because I have so much money already tied up in the healthcare industry. One of those companies that I've purchased into is Novo Nordisk, and HIMS is actually looking to partner with Novo Nordisk to offer Wegovy injections as well as their soon-to-be oral pills on their platform. And this is going to be a big catalyst for both of these companies. Novo Nordisk needs that direct-to-consumer kind of line of sight, while HIMS already has that platform built out with a number of subscribers that continues to increase year over year. And right now, the weight loss market is underserved, and the platform that HIMS has built out will allow Novo Nordisk to achieve a lot more market penetration. And as we see these oral pills rolled out in 2026, this could be a big catalyst for both of these companies. Right now, HIMS is trading at a forward P ratio of a 54.35. And of course, a 54 PE ratio is a little bit on the higher side. We talk about this on the channel, but a lot of investors believe that a 60 forward P ratio is really the max that a company is able to grow into and still offer decent returns for investors. Right now, though, the next year EPS number is projected by analysts at 67 cents. This has dropped from 81 cents 30 days ago. So there is a reason to be made, or an argument to be made, that right now EPS projections for 2026 are a little bit on the low end. And even for top line numbers, they're only anticipating about 19% growth year over year. Again, this could be a little bit low of a projection, especially if we see the weight loss market take off in a major way. So if we take a look at analyst EPS expectations for 2026, I'm honestly going to ignore this low expectation. On the low end, they're expecting 33 cents of earnings. In my opinion, I don't think HIMS is going to put up numbers that are that bad. I think they should grow a lot more than that in terms of their top line as well as their bottom line, and that should have a big impact on the business. If you look at those numbers, obviously they turn out really bad based off the valuations that come through for those numbers. But again, I don't think that's realistic. If we talk about inline expectations of 67 cents and a 45 forward P ratio, that would be $30 per share as a fair price. Again, that's a little bit below where the current share price is trading at. I don't think that this is a reasonable expectation either. I think honestly, they should be growing by 80 to 90 cents. I think that should be the average EPS expectation. But if we see them outperform, and I actually think that this is a realistic expectation for the company, especially again around this weight loss market and how much it could increase in 2026. That would be 185% growth for their bottom line numbers from 2025 to 2026. At that point, this company should easily trade at a 50 to 60 forward PE ratio, resulting in a stock price anywhere between $70 and $80 per share. So that is HIM stock, but let's go ahead and take a look at the next company on this list, which is Elf Beauty, ticker symbol ELF. Right now, it is trading at a share price of $70. If we look at their 52-week high of around $146 per share, the stock has dropped by over 50% in just the last couple of months, now sitting at a market cap of just over $4 billion. In terms of Elf's most recent earnings announcement, it was a little bit of a weird quarter. Their net sales increased by 14% year over year to $343.9 million. They also saw their gross margin decrease year over year by about 1.65%. And net income, they had some weird adjustments in. So they put up a GAAP net income of $3 million with adjusted net income coming in at $40.7 million. On an earnings per share basis, that was 5 cents of GAAP EPS or 68 cents of adjusted EPS. But honestly, if you are buying into Elf, it's because of the potential growth in front of this company. AUR stands for average unit retail. It's basically the average price per item that a customer is paying for your good. And what that comes out to for Elf is $7.50, while the rest of the market is around $9.50. This is a lot of runway for Elf to increase their prices and thus drive up revenue as well as improve bottom line numbers. And the other growth factor for this company is the growth that they should see over the next few years in their international markets. They have a number of brands that they're rolling out internationally that should see massive growth and help improve their top and bottom line numbers as well. And if you believe that Elf is going to execute well on these two strategies, right now it's trading at a valuation that is in line with the rest of the market for a company that should grow at a much quicker pace. They have a forward P ratio of a 26.11. Overall for 2026, analysts are expecting $2.85. That is a significant decline in earnings year over year from 2025 numbers of $3.39. A lot of this has to do with tariffs that has really affected Elf's bottom line, but in 2027, analysts have this turning around and the company getting back above $3 per share, putting up $3.52 of EPS. And they also have a slight increase in top line numbers. For 2026, for the full year, they are anticipating top line growth of 19%. When we look at 2027, they're anticipating top line growth of 17%. In my opinion, this number could be a little bit low. If we see this international expansion take place at a quick pace over the next 1 to 2 years, I think we could see 20+% growth for top line numbers for this company. When we take a look at analyst expectations, on the low end, they're expecting $3.10 of EPS. At an average multiple for the market of 25, we can see that the stock is basically trading right where it should be, around $70 to $80 per share. On the average side for EPS, that $3.52 number, that should really result in a multiple that is higher than the market, around a 30 forward P ratio. That would put their stock price at $105 per share or well above the current share price. At an outperform EPS of $3.89, that would be growth of the bottom line of almost 40% year over year, which should result in the stock trading at a forward P of around a 40, which means that the share price should be around $155 per share. So overall, when I'm looking at ELF, I see a very easy case for the share price to go up by 50 to 100% over the course of the next year. Or on the worst case, you really just break even over the course of the next year. So this is a company that to me is fairly attractive right now. But let's go ahead and jump into the third stock on this list, which is Reddit, ticker symbol RDDT. Right now, they have a market cap of almost $35 billion. Back in September, their share price was sitting at $270 per share. Right now, the stock is down about 32% to $183 per share. And in my opinion, Reddit is a very attractive company right now. Their daily active users has increased by 19% year over year, with revenue increasing by 68% year over year. I find Reddit as a very attractive platform for advertisers. If you think about where advertisers pay the most amount of money in terms of social media, it is long form content. It is companies like YouTube. And when you go down the list, Facebook, Instagram, and then on the bottom end, it's companies like Snapchat as well as TikTok. That's because on Snapchat and TikTok, people are scrolling through those posts very, very quickly and not paying much attention to ads. However, when you go up that list, YouTube, people are sitting there and watching 20, 30-minute episodes on YouTube. What they are doing on Reddit is spending 20 or 30 minutes reading different posts and basically going over blog posts. This offers a very unique opportunity to advertisers. And as this company continues to grow their top line numbers as well as grow their bottom line numbers, we should see their valuation expand. They are currently sitting at a forward P ratio of a 51.81. And overall, I think the company has the opportunity to outperform analyst expectations, especially on their top line numbers. But for bottom line numbers for 2026, analysts have an average EPS estimate of $3.78. But for top line numbers for 2026, they're expecting only 38% growth. In the current year, they are anticipating 65% growth. In my opinion, Reddit could grow their top line by 45 or even 50% in 2026, far exceeding analyst expectations. And Reddit is a company that has very nice margins, so increasing their top line numbers should result in faster growth for their bottom line numbers. The average EPS estimate for 2026 is $3.78. At a 55 forward P ratio, that results in a share price of around $207 per share. But again, in my opinion, I think they will grow their top line numbers faster than analysts are anticipating. The outperform or high end EPS estimate is $4.65. At a 55 forward P ratio, that would result in a share price of $255 per share. If you notice something about this calculation, it's that I kept their forward valuation at a 55. That is because personally, I do not like valuing companies at over a 60 forward PE ratio. Again, this has to do with companies struggling to keep up with growth needed to justify those valuations. But at a 60 forward PE ratio, that would result in a share price of almost $280 per share. But if this company is growing their bottom line numbers by almost 100% year over year, the market could very well increase this forward valuation. We see this with a lot of other companies, one of those most notably being Palantir, which is trading at multiple hundreds in terms of their valuation. The next company we have up here is Lemonade, ticker symbol LMND. They have a market cap of just over $5 billion, and we can see that this stock has crashed a little bit. It was trading at almost $80 per share, but has since fallen by about 15% to a current share price of about $67 per share. Lemonade is an insurance company, and in their most recent quarter, they brought in $1.16 billion of premiums, which increased by 30% year over year. Their gross profit increased by 113% year over year to $80 million. And what's probably most impressive is what they've been doing with their gross loss ratio, which has improved by 11% year over year to 62%. This is basically how much of their premiums are they paying out for car accidents or other insurance related costs. But overall, I honestly like Lemonade very much. I think this company has a lot of potential in front of it. The only concern that I have right now is they are not a profitable company. But I do think they are a company that will get there over time, especially as long as they keep growing their top line numbers at a very fast pace. Right now, we could see that they're averaging over the last 12 months a loss of about $2.39, but that has been declining over the last few years. Back in 2022, they had a loss of around $4.83. So they are well on their way to reaching profitability, but they do need to make that flip at some point, likely in the next 1 to 2 years. It's hard to value companies that are losing money, so I'm not going to give any sort of price prediction for Lemonade over the next couple of years, but it's certainly a company that I am going to be watching. The next company up here is Duolingo. Their ticker symbol is DUOL, and right now the stock is trading at $172 per share, but back in May of this year, their share price was over $540 per share. From that point till now, the stock has fallen by almost 70% to a market cap of just under $8 billion. And Duolingo is another company that is growing very quickly. Their daily active users is up 36% year over year to 50.5 million. Their monthly active users is now up 20% year over year to 135.3 million. And their paid subscribers, which is probably the most exciting metric for investors, is up 34% year over year to 11.5 million. And the reason this paid subscribers number is so attractive for investors is what it shows about the company. What it means is that people, once they get into the ecosystem and use the app frequently, they are very likely to convert to being a paid subscriber. And this also shows through in their paid subscriber penetration, which is up from 8.5% in Q3 of 2024 to 9% in Q3 of 2025. And this strong user growth has translated to very solid financial metrics. Their revenue has increased by 41% in the most recent quarter to $271.7 million. In terms of the long-term thesis for Duolingo, what I think could potentially happen is the privatization of education. And what I mean by that is there are so many things right now over the past 5 to 10 years that have gone from being exclusive to the rich to now being common things for average middle class families. If you think about Uber Eats and the delivery of groceries or food directly to your door, that used to be something that was exclusive to the rich. If you think about private cars picking you up and taking you to wherever you want to go, again, that used to be something that was exclusive to the rich. And now what we have seen with Uber is you can get a vehicle to pick you up anywhere and take you wherever. What Duolingo has in front of it is the potential of privatization of education. And right now, what I mean by that is the rich send their kids either to private school or they homeschool their kids. And what Duolingo could do over the next 5 to 10 years is offer the ability to homeschool your kids very easily. If Duolingo can offer a number of different learning services to their customers, it could offer parents the opportunity to let their kids really get schooling through Duolingo. Of course, it's not going to be that straightforward, and there is a long way for Duolingo to go, but right now, Duolingo is trading at a forward P ratio of a 42.55. But this isn't 100% accurate. If you look at 2026 numbers, analysts are expecting $7.93. This puts their forward PE ratio closer to a 20 to a 25. One thing I do want to note in here is for 2025 numbers, analysts are expecting $11.89. This is a little bit deceiving because they did have a one-time tax benefit that impacted their numbers in a positive way for 2025. For 2026 top line numbers, analysts are expecting growth of about 23% year over year. I personally think that they could grow their top line by closer to 25 to 30% in 2026. And ultimately, the reason the company is down so much is because they believe it is going to be disrupted by AI. But in my opinion, AI should actually enable Duolingo to perform at a higher pace. And what we could see across analyst expectations is on the low end of $7.70 of EPS in 2026 and a market multiple of around a 25 to a 30, the stock price should actually be around $200 to $230 per share. So even in this bear scenario, the stock appears to be undervalued at a current share price of around $172 per share. If we look at the average EPS estimate of $7.93 and a multiple of 35, that would result in a share price of around $275 per share. And on the high side, Duolingo putting up $8.10 of EPS in 2026 and a multiple of 40 for the company would result in a share price of about $325 per share. So across the board right now, Duolingo looks like a fairly attractive stock. I do want to call out that I currently do not own any of these companies. However, I will likely add positions in Duolingo, Reddit, and Elf. Those three companies to me offer the best risk reward as well as are outside of current positions that I hold, which what I mean by that is, again, going back to HIMS, I have a lot of healthcare companies. I would look to add HIMS. However, because I'm already so exposed to the healthcare industry, I don't think adding HIMS to the portfolio adds a whole lot of diversity like adding some of these other companies. But right now, this is what the portfolio looks like. I have shares of Google, AMD, Novo Nordisk, United Health Group, as well as Oscar, SoFi, Microsoft, Adobe, Alibaba, PayPal, United States Lime and Mineral, Abercrombie and Fitch, Estee Lauder, Zeta, Ford, and Hawkins. I could again see myself adding maybe $1,000 positions to those three companies being Reddit, Duolingo, as well as Elf. But let me know your thoughts down below. Which of these companies do you find most attractive? Do you have any of these in your portfolio? And what are your price targets for those stocks? Thank you guys so much for watching, and thank you again for the support on the channel. Make sure to drop a like down below and subscribe for more videos like this one. And as always, have a wonderful rest of your day.